And tax planning is something that you guys do with the families and individuals that you work with. And you've got a great example of how you look forward. We're going to compare and contrast two couples. We've got Mr. and Mrs. Pre-Tax and Mr. and Mrs. Tax Diversified.
Absolutely. They can be a little bit challenging to quantify the impact of proactive tax planning. And as we walk through this case study, we can see the impact of one family that had a proactive tax plan and one family that really didn't. So we've got the two different couples, Mr. and Mrs. Pre-Tax, and they've saved 100% of their assets for retirement in the pre-tax bucket. It's all tax deferred. Mr. and Mrs. Tax Diversified have more diversification across their portfolio. Not only do they have a pre-tax bucket, they also have some Roth dollars and non-qualified dollars. When we look at this example, both of them have saved $1 million for retirement, but everything else is the same other than the tax diversification within their portfolio. So we can see that they are both looking to spend $7,000 per month each and every month throughout their retirement. We show that that's going to go up over time with inflation. For these couples, they're the same age, they have the same retirement date, we've got the same Social Security amounts and election strategy that they're going to choose. The only difference is the tax diversification within their portfolio. As we look specifically at Mr. and Mrs. Pre-Tax, 100% of those dollars have been saved in that pre-tax bucket for retirement. That means when they take distributions out to get income, it will all be taxed at earned income rates. So as they, across their lifetime, as they go through their retirement, when they take distributions out for income and when they take distributions out for required minimum distributions, that's going to all be taxed. When we add up that total tax bill, we would find that they would have around $740,000 that they'll pay in taxes across their retirement. Sounds like a big number. We think about their assets are growing over time, and they're going to be taking those distributions out for income as well as the forced distributions at RMDH. So $742,000 of a federal tax bill that they have. We also can start to look at how do their assets grow over time. They've taken those distributions out, but when we look at age 100, they have around $670,000 that they would then be able to pass on to their beneficiaries. So as we start to think about this couple, they've accomplished a lot of the retirement goals that they have, but if they had been more proactive, like Mr. and Mrs. Tax Diversified, then they could probably see a very different impact. So when we look specifically at Mr. and Mrs. Tax Diversified, we can see that they have about 60% that's been saved in those pre-tax buckets, but by working with a retirement planner, so they once looked very similar to Mr. and Mrs. Pre-Tax, but by working with a retirement planner, helping more proactive tax strategies to implement, they've been able to develop about 30% of their overall portfolio into that Roth bucket. They've also started to build up this green part down here, which is non-qualified. About 10% of their portfolio is non-qualified. As they walk through retirement, they're still going to have a tax bill that they're going to experience. It's going to be around $500,000. Again, we're adding up each and every year throughout their retirement. We showed they'd have about a $500,000 tax bill. When we look at the impact of these assets growing over time, we are going to show that this family has about $1.2 million that they would be able to pass on to their beneficiaries in this example, assuming that they live to age 100. So that's very different than the couple that had saved 100% pre-tax. When we compare these two back and forth, we can see Mr. and Mrs. Pre-Tax, federal tax bill, about $740,000. Mr. and Mrs. Tax Diversified, by saving more diversified, they've been able to lower about $200,000 on the tax bill that they're going to pay across their retirement. When we think about the couples and what they had at age 100 from a legacy standpoint, Mr. and Mrs. Pre-Tax, about $660,000, they were able to pass on to their beneficiaries. Mr. and Mrs. Tax Diversified had $500,000 more. They were able to pass on $1.2 million to their beneficiaries as part of their legacy. Not only that, but also we start to think about the breakdown of how those assets are tax classified when they get passed on. We see that Mr. and Mrs. Pre-Tax still have about 50% of their legacy has never seen tax before. Now their kids or their beneficiaries are going to pay the tax bill on half of those dollars. But when we look at Mr. and Mrs. Tax Diversified, not only did they have $1.2 million, 100% of that was Roth, which means that their beneficiaries will not have a tax bill associated with those dollars. They will get the actual $1.2 million with no tax bill that's tagging along like Mr. and Mrs. pre-tax faced. So we can see this comparison of the proactive tax planning versus the family that had saved pre-tax and really didn't make any shifts to prepare for their retirement tax bill.
Wow, what a difference. Mr. and Mrs. Tax Diversified really did a good job of creating that tax diversification as they went to and through retirement. They saved over a couple $100,000 off their retirement tax bill. Then at age 100, they had significantly more money than Mr. and Mrs. Pre-tax, and they were able to pass on a whole lot more to their kids. And when their kids received this money, they had a lot more tax benefits available to them because of the diversification that Mr. and Mrs. Tax Diversified created. So if you're sitting there at home thinking, sign me up for Mr. and Mrs. Tax Diversification, that's what you want. There are a lot of hurdles that you have to overcome to do that. That does not happen by accident. Most people are Mr. and Mrs. Pre-tax because those are the types of vehicles that you had available to you to save your money in over the course of your savings career. But now it's a matter of how do you take that money systematically, intentionally, and diversify it from a tax standpoint to make sure that you can optimize your overall portfolio from a tax standpoint and put yourself in a position where potentially you can have a retirement like Mr. and Mrs. Tax Diversified.
And I want to make a note for those that are watching. Maybe it could be just a Mr. or just a Mrs. Tax Diversified. This works for singles as well.
Yeah, in some cases, it's even more important if you're single to have a proactive tax plan. All of those dollars that you have saved, you're going to be filling up the tax brackets quicker as a single person. And then the other thing you always want to think about is what if it was a couple that was married, they've saved together, built that together, one of them passes, now you're taxed at single tax rates for the surviving spouse.
Thanks for watching. If you liked this clip, check out the full episode right here. We'd love to keep you in the loop. Hit subscribe to be connected with other pre-retirees just like you who are looking for engaging and entertaining retirement strategies.